When people think about financial crises, they picture stock market crashes, bread lines, or desperate investors jumping from windows. But there's something far more terrifying than losing money in the market. It's walking into your bank and being told they simply cannot give you your own money back. And in March 1933, that nightmare became reality for every American. For 1 week, every bank in the United States was closed by government order. Not just the failing ones or the sketchy ones, literally every bank in America. Imagine waking up to find that your life savings, your paycheck breaks, your rent money, all of it locked away behind doors you couldn't open. This wasn't a natural disaster or foreign invasion. This was your own government telling you that the financial system had become so broken, so dangerous, that they had to shut it all down before it destroyed everything. The week of March 6th to 13th, 1933, changed America forever. And the lessons from those 7 days reveal a terrifying truth. When banks fail, governments don't protect you first. They protect themselves. And they'll lock you out of your own money to do it. Let's set the stage. By early 1933, the United States was drowning in the Great Depression. Nearly a quarter of Americans were unemployed. Factories stood empty. Farms were abandoned. And at the heart of it all was a banking system in complete meltdown. Since the stock market crash of 1929, over 5,000 banks had already failed. That's not a typo, 5,000. Each failure wiped out the savings of ordinary people who had trusted their local banks with everything they had. To understand how devastating this was, consider that in 1929, America had roughly 25,000 banks. By 1933, 1 in 5 had vanished. Unlike today, these weren't just branches of mega corporations. These were community banks where farmers deposited their harvest money, where local businesses kept their payrolls, where families saved for their children's education. When your bank failed in 1933, there was no Federal Deposit Insurance Corporation to reimburse you. There was no government safety net. Your money simply disappeared. The banking system of the 1920s operated on what's called fractional reserve banking, a system where banks only keep a fraction of deposits as cash reserves and lend out the rest to earn interest. For example, if you deposited $100, your bank might keep $10 in the vault and loan out $90 to someone buying a house or starting a business. This works fine when only a few people want their money back at any given time. But when everyone rushes to withdraw simultaneously, what we call a bank run, even perfectly healthy banks collapse because they don't have enough physical cash on hand. But the real crisis wasn't the banks that had already failed. It was the panic spreading to the ones still standing. In the weeks before March 1933, Americans had begun what economists call a bank run, racing to withdraw their money before their bank became the next to collapse. The problem was simple math. Banks don't keep all depositor money sitting in vaults. They lend most of it out. When everyone demands their money at once, even healthy banks can't pay. Fear was becoming self-fulfilling prophecy. Good banks were being killed by the same panic that had already destroyed the bad ones. The psychology of bank runs is particularly vicious. Once rumors start that a bank might be in trouble, depositors rush to withdraw their money just to be safe. But this very act of mass withdrawal creates the crisis they feared. It's like shouting fire in a crowded theater. Even if there's no fire, people can still get trampled in the stampede to the exits. Newspapers of the time carried photographs of desperate crowds gathered outside bank doors, clutching withdrawal slips, many learning too late that their institutions had already closed permanently. By March 4, 1933, Franklin Delano Roosevelt was inaugurated as the 32nd president. That same day, the governors of New York and Illinois, the financial capitals of America, declared bank holidays in their states. Other governors followed like dominoes. Michigan had already closed its banks in February after the massive Guardian National Bank of Commerce collapsed, taking down the entire Detroit banking network. Nevada followed suit, then Maryland, then Ohio. The banking system wasn't just failing, it was disintegrating in real time. Americans went to bed on March 5th not knowing if their banks would be open the next morning. Most weren't. The term bank holiday itself reveals the government's mastery of language manipulation. A holiday suggests celebration, rest, voluntary time off. But this was no holiday for the millions of Americans who suddenly couldn't access their life savings. It was an enforced financial quarantine designed to stop the contagion of panic by literally preventing people from withdrawing their money. Then came the unprecedented decision. On March 6th, just 2 days into his presidency, Roosevelt did something no American president had ever done. He closed every bank in the country. The official term was bank holiday, as if Americans were being given a cheerful day off from their money. The reality was martial law for the financial system. Presidential Proclamation 2039 invoked the Trading with the Enemy Act, a wartime law originally passed in 1917 to control commerce with hostile nations during World War I. The government had literally declared war on its own financial system. This legal maneuver was crucial to understand. The Trading with the Enemy Act gave the president extraordinary powers during wartime, including the ability to regulate or prohibit any transactions in foreign exchange, transfers of credit, and the export or import of currency. Roosevelt's stroke of genius was applying a wartime law to a domestic financial crisis, instantly giving himself dictatorial control over American banking. It was constitutional jujitsu, using existing legal frameworks in ways their original authors never imagined. For the next week, America operated without banks. Think about what that means in practice. No paychecks could be cashed, no bills could be paid by check, no loans could be made, businesses couldn't access their accounts to pay workers or suppliers. The entire monetary system of the world's largest economy simply stopped. Americans had to survive on whatever cash they had in their pockets when the banks closed. Many had almost nothing. The human cost was immediate and brutal. Workers showed up for jobs but couldn't be paid. Landlords couldn't collect rent, but tenants couldn't pay it anyway. Grocery stores ran on IOUs or refused credit entirely. Hospitals struggled to buy supplies. The Postal Service nearly shut down because it couldn't access funds to operate. For 1 week, the United States had been forced back into a barter economy, like a medieval village where people traded chickens for bread. Real stories from that week paint a vivid picture of the chaos. In Detroit, General Motors had to pay workers in scrip, essentially company-issued IOUs that could only be spent at company stores. New York City school teachers were paid in tax warrants instead of cash, forcing them to hawk these paper promises at discounts to anyone willing to buy them. Farmers brought vegetables directly to city markets, accepting watches, jewelry, or anything of value in trade because paper money had become suspect and banks couldn't process transactions anyway. Hotels found themselves in impossible situations. Guests who had checked in before the bank holiday suddenly couldn't pay their bills, not because they lacked money, but because their money was locked away. Some hotels extended credit indefinitely. Others threw people into the streets. Wedding ceremonies were postponed because couples couldn't access funds to pay ministers or reception halls. Funerals were delayed because families couldn't withdraw money for burial expenses. The bank holiday had frozen not just the economy, but the basic rhythms of life itself. But here's what makes this story truly chilling. The government used this crisis to fundamentally reshape American banking forever. On March 9th, just 3 days after closing the banks, Roosevelt called Congress into emergency session. In a single day, one day, Congress passed the Emergency Banking Act. Most members didn't even have time to read it. The bill was literally still wet from the printing press when they voted. It gave the federal government sweeping new powers over banks, including the authority to investigate, reorganize, and reopen only those institutions they deemed sound. The speed of this legislation was breathtaking and terrifying in equal measure. The Emergency Banking Act was introduced in the House of Representatives at 1 p.m. on March 9th. By 4 p.m., it had passed the House. By 7:23 p.m., the Senate had approved it. By 8:36 p.m., Roosevelt had signed it into law. In less than 8 hours, Congress had fundamentally altered the structure of American banking. Most representatives voted for a bill they had never seen, trusting that whatever it contained was necessary to end the crisis. Who decided which banks were sound? government inspectors working in secret, using criteria that were never fully disclosed. These inspectors, many of them political appointees with no banking experience, wielded life or death power over financial institutions. Thousands of banks that had been operating legally just days before were now judged unsound and shut down permanently. Their depositors lost everything. Meanwhile, the larger banks, the ones with political connections and federal favor, were declared healthy and allowed to reopen. It was the most massive consolidation of banking power in American history, accomplished under the cover of emergency. The inspection process itself was a masterpiece of arbitrary power. Teams of federal agents descended on banks across America, examining books, questioning officers, and making snap judgments about which institutions deserved to survive. No standardized criteria existed. No appeals process was established. Banks that had served their communities for decades were shuttered based on the subjective assessment of government bureaucrats who often knew nothing about local economic conditions. On March 12th, Roosevelt delivered his first fireside chat to a nation huddled around their radios. In calm, reassuring tones, he explained that the banking crisis was over. He promised that only safe banks would reopen. He asked Americans to trust their government and return their money to the system. It was one of the most masterful pieces of political theater ever performed. Roosevelt had caused the largest financial panic in American history by closing every bank, then positioned himself as the savior who fixed it by reopening some of them. Roosevelt's radio address was a watershed moment in American political communication. Speaking directly to citizens in their living rooms, he used simple language to explain complex financial concepts. He compared the banking system to a patient requiring surgery. Drastic action was necessary to save the whole body. He assured listeners that banks reopening had been thoroughly investigated and were, in every respect, safe. The irony was perfect. The man who had created the crisis by shuttering all banks was now being praised for his wisdom in reopening only some of them, and it worked. When banks began reopening on March 13th, deposits flooded back in. People lined up to put money into the same institutions they had been desperately trying to withdraw from just days before. The panic was over, but the damage was permanent. The federal government had seized control of American banking. Thousands of smaller banks had been eliminated, and the precedent was set. In a crisis, your access to your own money depends entirely on government permission. What should terrify you about this story isn't just that it happened once. It's that the same tools used in 1933 are still on the books today. The Trading with the Enemy Act that Roosevelt invoked? Still law. The federal power to close banks and freeze accounts? Still legal. The ability to declare financial emergencies and override normal banking operations? Still available to any president willing to use it. In fact, the banking system today is far more fragile than it was in 1933. Back then, thousands of independent banks meant that failures could be contained locally. Today, a handful of megabanks control the vast majority of American deposits. J.P. Morgan Chase, Bank of America, Wells Fargo, and Citigroup together hold more than $8 trillion in assets, roughly 40% of all U.S. banking assets. When one of them fails, the entire system trembles. And with digital banking, a modern bank holiday wouldn't just lock physical doors, it would shut off ATMs, freeze online accounts, and stop electronic payments instantly. Your credit cards, your direct deposits, your mortgage payments, all of it could disappear with a keystroke. The interconnectedness of modern banking makes the system simultaneously more efficient and more vulnerable. In 1933, if a bank in Kansas failed, it might affect that local community, but wouldn't necessarily impact banks in California. Today, major banks are connected through a web of overnight lending, derivative contracts, and electronic payment systems that span the globe. A crisis at one institution can cascade through the entire network in minutes, not weeks. The 2008 financial crisis gave us a preview. Major banks like Lehman Brothers collapsed overnight. Others survived only through massive government bailouts. Account holders at Washington Mutual, one of America's largest banks, went to bed on September 25th and woke up to find their bank had been seized by federal regulators and sold to J.P. Morgan Chase. Their deposits were protected, but their bank was gone. It happened in a single night with no warning to customers. But 2008 was just practice. The real test came in 2020 when the COVID-19 pandemic gave governments worldwide an excuse to freeze economic activity on a scale that would have made Roosevelt jealous. Central banks printed money at unprecedented rates. Governments shut down entire industries. And financial surveillance expanded dramatically, with every transaction monitored, every account trackable, and every citizen's economic behavior subject to government approval. The tools of financial control have only grown more powerful. Today's Federal Reserve can manipulate interest rates, purchase assets, and create money with computer entries that dwarf anything possible in 1933. The Treasury can freeze accounts, track transactions, and sanction individuals or businesses instantly. And with the rise of central bank digital currencies, government-controlled digital money, the possibility of complete financial surveillance and control is closer than ever. Central bank digital currencies, or CBDCs, represent the ultimate evolution of the power Roosevelt seized in 1933. Unlike physical cash, which provides some anonymity, or even traditional electronic banking, which requires court orders to monitor, CBDCs would give governments real-time visibility into every transaction every citizen makes. They could impose spending limits, restrict purchases of certain goods, or even set expiration dates on money to force consumption. The Chinese government is already testing such a system, and the Federal Reserve is actively researching American CBDC implementation. Imagine a world where your government can see every cup of coffee you buy, every donation you make, every subscription you purchase. Imagine money that comes with built-in restrictions. You can spend it on groceries, but not on books the government deems inappropriate, on transportation, but not to certain locations, on approved retailers, but not on independent businesses. This isn't science fiction. It's the logical endpoint of the financial control mechanisms established in 1933. So what does the bank holiday of 1933 teach us? First, that your money in the bank is not really yours. It's a promise that can be broken whenever the government decides it's necessary. Second, that financial crises are often used to expand government power permanently, with emergency measures that never quite go away. Third, that when the system collapses, ordinary people pay the price, while those with political connections emerge stronger than before. The week your bank could not pay you reveals a fundamental truth about financial systems. They exist to serve power, not people. Roosevelt's bank holiday eliminated competition, consolidated control, and established precedents that every subsequent administration has built upon. The Americans of 1933 traded financial independence for the promise of stability. Instead, they got a system designed to survive crises by sacrificing individual financial rights. Today's financial system operates on the same principle, just with more sophisticated tools. The next time banks cannot pay you, it won't be because they're closed for a week. It will be because your government has decided your money is a threat to stability, your transactions are suspicious, or your financial behavior needs modification. And unlike 1933, there will be no cash alternative, no independent banks to eventually reopen, and no legal framework protecting your access to your own wealth. The precedent was set nearly a century ago. In a crisis, your government will choose system stability over individual rights every time. They will call it necessary, temporary, and in your best interest. They will use calm voices and reassuring words while they lock away your life savings. And when the crisis passes, the emergency powers will remain, waiting for the next excuse to be used again. If this analysis opened your eyes to what's really coming, hit subscribe. I'll be breaking down the International Emergency Economic Powers Act, explaining how CBDCs actually work, and showing you the specific legal mechanisms that could freeze your wealth tomorrow. History doesn't repeat, but the patterns are unmistakable, and I'll show you exactly where to look for the warning signs.